Well, it gives me, as always, great pleasure to have Mr. V. Vaidyanathan, CEO and Managing Director of IDFC First Bank, to talk about how things have transpired for the quarter gone by. More importantly, how will FY26 be different from FY25? Because in markets, you always have to focus on rate of change. And is the rate of change for the bank per se getting better? That is what we need to focus on. So, the prima facie numbers, Mr. Vaidyanathan, they look impressive. Retail growth, overall growth in a tough environment, that's impressive. So the bank, in terms of the headline number, has ticked all the boxes.
That is very true. The way we see it is that the core balance sheet item of the bank are actually doing quite well, because the loan book has grown by 20%, deposits by 25% in this environment. And this is after the fact that we dropped rates. So this is actually the core franchise of the bank, which is, after my experience, all that, that's very strong. So one thing that we are, that we went down on in terms of, was not a good pick, was the fact that the PAT of the bank came down this year. That we will address in the upcoming year.
I'll first address the elephant in the room, and that is about not the core growth, that is about the MFI book. It has been an industry-specific problem, and I distinctly remember when I spoke to you last time, you did allude to the fact that the worst was behind us. But in this quarter also, some stress was visible. So is the worst really behind in the MFI book?
No, let's be very clear about what we said. We said that the provisions of MFI, because we model a book and we see the impact, we had said that will peak in Q4 of FY25. And then we said that every quarter after that, progressively, provisions on microfinance should come down. Basically, it's think of a wave. So initially it went up, peaked out, and then it is coming down. So we stand by that. So we already called out that Q1 of 26, you should see MFI provisions less than Q4. Q2 should be less than Q1, and Q3 should be less than Q2, and so on. So we feel the wave is receding, so to say. But we should be very careful. This is a very sensitive segment. In fact, our SMA numbers of microfinance already suggest that to us.
So are you ready to call out a bottom in the MFI book, or it's going to be still wait and watch?
Well, like we said, that the provisions is peaked out. So it will, provisions every quarter on MFI will come down from here on.
The FY26 trajectory for IDFC Bank would be dramatically different from FY25. I think that is what we need to focus on. One, the economy per se has improved. MFI positioning has reached its peak. And then third, access to 7,500 crore of capital. So I think the bigger question we need to understand and perhaps bring out for our viewers is that how will FY26 be different from FY25?
Well, the key thing that is going to be different, like we said, that provisions are going to be lesser. But more importantly, actually, is the Opex. I think a bank has done a really good job in scaling up the bank without increasing Opex. For the last 4 quarters, our Opex growth YOY, if you take Q1 FY25, YOY growth was 21%. Q2 Opex grew by 18. Q3 Opex grew by 16. Q4 Opex grew by 12. So it's a very clear trend that we are tightening the Opex strings in the bank, and that should also help the bank. So we should look at 25 as a much better year. Of course, it's coming off a low base, so to say, but we should look forward to a better year, basically from the Opex point of view and from credit cost point of view as well.
But your gross and net slippages, and you'll appreciate the spirit of my question, they are still elevated. The gross number stands at 3.8, the net number stands at 2.8. Do you see an improvement happening there?
Net is 1.86 actually, and this year, if you remember, we had the toll road issue, which was the Mumbai entry point. There was a toll road that was like a large exposure that, and there was also this issue about the microfinance, which also slipped heavily. So but having said that, our Q4 slippage, just to be clear, is distinctly lesser than Q3. So and that's also because the MFI slippage is still higher compared to Q3, which is actually it will peak this quarter. But the non-MFI book slippage actually coming down. So I believe that on the whole, the total SMA book actually come down this quarter. It's actually, like I said, it has implication about subsequent quarters, credit cost and so on. So long and short of it, we feel that the real thing about the bank was the MFI issue. We're in the bank in the center of it. We acknowledge that. But the rest of the book, that's like that's like 2.3 lakh crore. That is really solid, really solid. We actually put out even SMA numbers by product in the market. Very solid.
The other underappreciated aspect of the bank is the CASA numbers. Walk us through that, where the CASA numbers they stand. I mean, the retail deposit growth has been nothing short of outstanding in a tough liquidity environment.
CASA is the big thing for the bank, actually. If you notice, for the last 5 years at a stretch, our CASA has moved from like 8.6% to 47%. I really don't think any bank has really done that much of a progress in CASA, at least in Indian banking history. This is a really good thing for the bank. We are really focusing a lot on customer service, customer experience, and definitely one of the big factors. And now, of course, we'll be dropping interest rates, and it will be our endeavor to continue to maintain CASA percentage while dropping interest rates.
Where markets are perhaps not appreciating is the potential of ROA improvement. Is that something which you see as a real deal in FY26, that because of cost, Opex, other factors, cost of capital, your ROA could dramatically improve, which in a sense markets have questioned in the last 12 months?
Yes, markets have questioned in the last 12 months. We know the reason. We talked about MFI issue. MFI actually squeezed two things for you. One, we shrank the book, so that income. Second, credit cost came because there was a cycle. So, this year is kind of depressed for that reason. But we certainly are endeavoring that by exit quarter of FY26, we want to get back to 1%. And, in the interim, it will be a phased approach to get there because quarter on quarter, see, frankly, we expect our Opex to grow only by about 13% this year, or 12.5 to 13%. Even though we want to grow the book meaningfully. So that is a very big operating leverage, I'd say. Okay. See, the main thing to, of course, observe is that this year, while the book may grow by 20%, income will not grow 20%. I just want to be clear about that, because the microfinance composition is coming down and yield is coming down. So income may grow by maybe 14% or 13-14%, maybe 13.5%. But Opex also will grow much lower. And 27 really will be a breakthrough year. And by Q3, Q4 of FY26, we should expect significant progress or breakthrough.
So your cost to income ratio is something which has a legacy issue. And this is something, since I've tracked the franchise for a while now, it's just been such a pleasure to track this franchise. Everybody was hoping that the cost to income ratio should settle down in coming quarters. Where do you see the cost to income ratio moving? Because if that comes down, then that is another lever for the bank in coming quarters.
It is the lever, let me say. This is one of the most important levers. So, cost to income has cost and income. It's cost divided by income. So income got affected because of the microfinance thing. So no matter we're cutting the cost, the income is also, reduced. So therefore, it is still very elevated, and that, frankly, it had come down sharply from 95% to 72, 73. But then the vehicle got stuck there for a couple of years. We think that by Q3, Q4, it should meaningfully come down because the base effect will come in. And 27, 20, 29, I definitely expect the bank to start delivering cost income. Think of it that we were driving well, got stuck for a while because of ABC reason, but the journey will start again. And people will see it. This period of 2 years where it did not come down, let me say, is a temporary period.
Wrap it up with one more, final point. You are in the middle of expansion, new branches, investment in technology, and yet you're guiding to a lower Opex. So are you going to go slow in your expansion? Are you going to go Are you going to be cutting some corners there? What is the thought behind going low on Opex?
No, we'll not cut corners, but we'll cut costs. And that is the way we will think about it. We really never cut corners as a bank. We think of ourselves like a really large bank in the making. That's how we think. That's how we're building the bank, we're building everything. That's how we're raising capital. You think of the big 3 or 4 banks. You think of that zone and scale they play. We see ourselves playing for that. Now, in terms of the cost, we have. We believe that with the arrival of so much of technology and generative AI and newer technologies coming in, you can do a lot more with less. And that is the reason why cost is coming down, not because we cut any corners.
So FY20...
For example, the next year, we expect like our Opex to grow only by 12-13%. Let's call it 13 just to be safe. And that will be a material drop, coming down from the last year. By the way, our balance sheet grew by 22%, but our Opex grew only 16. Next year, we want to grow balance sheet by 20, but we want to grow Opex by 12. So these are some significant progress we're doing.
So if I wrap up today's interaction, Mr. Vaidyanathan, headline number 1 is that MFI provisioning has peaked. Headline number 2, FY26, the base effect of the MFI book would kick in. Third, Opex will come down, and you see a marked improvement in ROA in coming quarters.
In the coming quarter, I'm talking of Q3, Q4. Definitely, I'm expecting it. But it's a gradual progress from now on. But you should definitely expect that the PAT level of the bank should only go up from here because the microfinance story is behind us. And frankly, it is only microfinance because the rest of the levers, CASA, deposits, loans, all that is, and excluding microfinance, they're all doing well.
Vaidyanathan, appreciate your time. Good luck for the current financial year, and thank you very much for joining us.
Thank you.
If you like this video, then like, share and subscribe to ET Now.